Today, we're going to cut through the noise and give you a foundational look at options trading, what they are, how they actually work, and the biggest risk you absolutely have to know about. Here's the game plan. First, we'll define what an option even is. Then, we'll look at the call option, which is your bet on a price going up. After that, we'll cover the put option, which is all about protecting yourself from a price drop. And finally, we're going to talk about the biggest risk of them all.
All right, let's get right into it. What is an option really?
This is the most important thing to get right from the start. An option is not a share of a company. It's a contract. And this contract gives you the right, but, and this is key, not the obligation, to buy or sell a stock at a very specific price by a certain date.
Okay, so every single one of these contracts is built on three essential parts. First, you've got the premium. That's just the non-refundable price you pay for the contract itself. Second is the strike price. Think of this as your locked-in price to buy or sell the stock. And third, the expiration date. If you don't use your contract by this date, it just disappears. Poof, it's gone. So let's look at the first type of option you'll encounter, the call option. Simply put, this is how you bet that a stock's price is about to go up. The best way to understand this is with an analogy. So imagine there's a cool new prototype drone selling for $3,000. You have a strong hunch its value is going to shoot up to $5,000 really soon, but you don't want to risk plopping down the full $3,000.
So instead, you buy a call option. You pay the seller a $100 fee that you'll never get back. That's your premium. In exchange for that $100, you get a contract that gives you the right to buy that drone for the locked-in price of $3,000. That's your strike price, anytime in the next 30 days. And that 30-day window, that's your expiration.
So what happens next? Well, there are really only two ways this can play out. Outcome number one. You're right. The drone's value hits $5,000. You can use your contract, or exercise it, buy the drone for that locked-in $3,000, and immediately flip it for a nice profit. Outcome number two. You're wrong. The drone's value goes nowhere. Your 30-day contract expires. You're not forced to buy it, but that $100 you paid for the premium, it's gone for good. Okay, so that was betting on a rise. Now, let's look at the flip side, the put option. You can think of a put as being basically like an insurance policy. It's a way to protect yourself if you think an asset's value is going to drop. Let's use another analogy here. Let's say you own a very valuable custom RC plane. It's worth $5,000, and you're really worried you might crash it on its very first flight, losing your entire investment. So you buy a put option to protect yourself. You pay a $500 policy fee. That's the premium. In return, you get a contract that guarantees you the right to sell your plane for $5,000. That's the strike price, no matter what happens to it, for the next 6 months. And that 6 months is, you guessed it, the expiration date. And again, there are two outcomes. Scenario one, the worst happens. The plane crashes and its value is now zero. But because you have that contract, you can exercise it and sell the wreckage for the guaranteed $5,000 strike price, saving you from a total loss. Scenario two, the plane flies perfectly, everything is fine. Well, your 6-month policy expires and you're out the $500 you paid for that premium. But hey, your asset is safe. Now, you might have noticed that in both of those examples, the worst-case scenario was just losing that initial payment, the premium. Well, that cost of entry leads us directly to the single biggest risk in all of options trading. So what is it? What's the one thing that makes options fundamentally so much more dangerous than just buying and holding a stock? The answer is simple. It's the ticking clock. With options, time is always your enemy. See, unlike a stock, which you can technically hold forever, an option has a fixed death date. If the stock price doesn't move past your strike price in the direction you need it to by that date, the contract doesn't just lose value, it literally vanishes. It ceases to exist. This is called expiring worthless. And when that happens, the investor loses 100% of the money they paid for the premium. And this leads to a pretty brutal statistic you need to hear. The overwhelming majority of options contracts that are bought expire completely worthless. That means the buyer loses their entire investment every single time. So what's the takeaway here? The golden rule is this. Options are an advanced, high-risk strategy. They are not for beginners. If you're just starting out, your focus should be on long-term holding of actual shares in good companies and broad market ETFs. Subscribe to Stick Market for more informative content.